Uh, Hello, welcome back to the continuing lecture in investments. So, in our last session, we were, basically talking about uh, the the separation property, right? That was, first uh, developed by James Tobin, right? The idea, basically, the idea behind uh, a separation property implies that portfolio choice can be divided into two separate tasks where optimal risky portfolio uh, is a purely technical problem by analysts, and the complete portfolio will include personal choice of the best mix of risky portfolio and risk-free assets. Because, the optimal risky portfolio is already uh, chosen by the analyst to raise uh, the maximize the Sharpe ratio. Of course, then how this Sharpe ratio is calculated. I mean, Sharpe ratio is depends a lot on the quality of data. Right? In other words, if the analyst is doing a good job and has gathered, compiled, uh, truly, uh, uh, the best, most efficient opportunity sets, that the Sharpe ratio will be, higher than the case where the analyst has done a poor job, and uh, the opportunity investment opportunity sets by this analyst is inferior to the ones that of the opportunity sets by the other analyst. So it may vary depending on the quality of the job that the analyst as the portfolio manager has done. But it doesn't change the fact that um, the optimal risky portfolio is a technical part, purely a technical problem. And then whether you want to put 45% into risk-free assets, or and then 55% into optimal risky portfolio or not, right? Or 30%, 70%. I mean, it's all kind of personal choice, right? And no matter what this weight will be, the Sharpe ratio of your complete portfolio will still be the Sharpe ratio of the optimal risky portfolio. But that's what so optimal, I just explained this. Optimal risky portfolios for different clients vary because of the constraints on short sales, dividend yield, tax considerations, or other preferences. Yes, I mean, if all, this is another thing, right? Uh, most cases, right? Different clients, different investors have different constraints, and most portfolio, most basic assumption is that short sell is there's no limitations to short sell, right? But some investors, due to it's simply either because of their organization's goal, or if it is an institutional investor, or personal philosophy if it is a personal investor. Sometimes you may have limitations, restrictions on short sell, and also some investors want to maximize their dividend yield. I mean, dividend yield is basically what? Dividend divided by market price. And those who want to reap high dividend, and it's like interest in the coupon, right? If you want high coupon, right, you will go for high coupon, current yield, and tax considerations, and et cetera, right? Also, if you don't like short sale, I mean, if your organization doesn't endorse short sale, then it's basically of course, the weight of all the assets should be one, and weight of none of the assets should be negative. Makes sense? Short sell, if the weight is negative, that means it's a short sell. So that's the theoretical basis of mutual fund industry. A few portfolios are sufficient to serve a wide range of investors. If optimal portfolio is the same for all clients, management is more efficient and less costly. I mean, if that is the case, right? Of course, reality, there will be optimal risky portfolio would vary, right? But you might not, if that is the case, you might not, benefit from Sharpe ratio maximizing optimal risky portfolio. I mean, with these constraints, right? But if there is no such constraint, right, one management firm can serve, which means asset management, can serve a number of clients with relatively small incremental administrative costs. When different managers use different input data, this is what I said, the quality of data, quality of, analysis, the quality of analysis matters, right? Then it will result in different efficient frontiers and different optimal portfolios, and this is where the real competition among portfolio managers are very keen. I mean, this is the real arena for competition among portfolio managers. In sophisticated security analysis that produces, input estimates, right? The better analysis, the more sophisticated analysis will result in better estimates. And if quality of security analysis is poor, a passive portfolio such as market index fund will yield better results than an active portfolio tilted towards seemingly favored security. Yes. Now, so as an example, this is a internationally diversified, portfolio, right? We put in this example, we put everything together, and actually, this is based on this data, right? Which is, table 6.1, efficient distribution, or it's hard to read, what they did was they, basically, excess returns data, and in the US, mean standard deviation of excess returns, Sharpe ratios, UK, France, Germany, Japan, China, 6-country data, and the excess mean of the excess return. Take a look at the mean of the excess return. I mean, it's not easy to see, but let's try. Looks like US mean is 0.06 something. It's like I need another data. That table is actually screen capture of the table from the book, and ebook, and then because it was the original image was even the original image didn't have a good resolution, but what can you do? So I had to also look into the pages of the book, or the relevant page of the ebook, and then barely figure out the numbers. But we don't need the actual number. I mean, exact number. Just from the graph, we can take a pretty good guess of the those numbers. Let's see. Oh no, I don't. Okay. So just from this graph alone, right? Let's see what this is. Of course, this purple line is straight line is PEL, right? Capital asset allocation line, and then this blue curve is the efficient frontier. Efficient frontier. What is this yellow curve? That's also efficient frontier, but without short sale, right? Without short sale. If there's a short sale, restrictions on short sale, this is what you can achieve. And this is, of course, with short sale. Okay. And then we understand this is the minimum variance. It's called, global minimum variance with, short sale. And this is, without, minimum variance without short sale. Now the US So this is the excess return of the U.S. with, standard deviation. These plots are all so it's kind of, Sharpe ratio of US, and this is kind of Sharpe ratio for UK. And UK and US, they are pretty much, close in terms of the the standard deviation, right? In terms of standard deviation, most like 15%, whereas US has a higher excess return, which is about 6%. UK about 5 point something, right? Yeah. France has a higher excess return, but the standard deviation is much higher. So standard deviation is about 22%, whereas excess return is about close to 7%. But in terms of Sharpe ratio, this cannot beat US or UK because let's try 6, for example, 6 divided by 15, or simply by a rough estimate, right? And they already calculated the Sharpe ratio. Oh, let me quickly, which one, in terms of Sharpe ratio, are they good? Which one is better? Sharpe ratio of US 0.4 something, Sharpe ratio of UK 0.3 something, Sharpe ratio of France 0.3 also something. It's hard to read. If I blow it up a little, that would be, yeah. US Sharpe ratio is 0.4013, UK 0.355, France 0.338. So in terms of Sharpe ratio, it's exactly in this order. US, UK, France, and Germany, look at the Sharpe ratio, 0.22. Japan, 0.187. China, the worst. Sharpe ratio, Japan, 0.23. Sharpe ratio of China, 0.24. So in other words, it looks like if you look at just the returns data, right? Germany seems to be doing very well. France seems to be doing, better than US and UK, and China seems to be doing also better than France. But look, it's the Sharpe ratio that matters, right? And the more northwesterly, the better it is. And the China is the worst in Sharpe ratio. Second worst, Japan. Germany in the middle, France. And the correlation also, if you look at the correlation between, US, UK, France, Germany, highly correlated. You can see the correlation is, above, 0.8 something. I increase, yeah, 0.83, 0.85. So that's a very high correlation, right? And Japan, 0.43 with, US. 0.16. China has a correlation of 0.16. That low? That's so. I forgot. This was based on what year, what period, but I'm sure it wasn't that long ago. It was like at least 2000, early 2000, right? 2001 through 2010, based on more recent data. And if the correlation is that low, then that means there's still something to be gained from international diversification, right? International portfolio diversification. So anyway, so this is the global minimum variance point with no restriction on short sale. Now, so this is the tangency point. So this is where the Sharpe ratio is maximum, right? And that's the optimum. Therefore, that's the optimum, combination, optimum, investment opportunity set. Without any restriction on short sale. And this diamond is the optimum when there is no restriction on short sale. Okay. You might wonder, yeah, with or without short sale, pretty much the Sharpe ratio is the same because it's one capital allocation. Both one this single capital allocation line is touching tangent on both, right? You can see that by international diversification, you can achieve more northwesterly, right, combination, more and higher, higher Sharpe ratio, and more westerly investment opportunity sets. Now, the vertical intercept is zero because it's the risk premium. We're dealing with risk premium. In other words, there's no. If it is not risk premium, it would start from vertical. Will be a vertical intercept will be a risk-free return, but because risk-free return is subtracted already, and there is no vertical intercept. It has to be zero, right? Okay. Now, and here's the interpretation of this is already what I explained, so I'm not going to go over this again. It's just the summary. And I just want to point out that the Sharpe ratio of our optimal risky portfolio is higher than US, Sharpe ratio of US and all countries, right? So we're now moving on to a single index stock market, single index model. And what is a single index model? Um, it's a model that relates stock returns to returns broad market index. And firm specific factors slash firm specific factors. And this is pretty much like CAPM. You may remember, but what is CAPM? CAPM is really a variant of single index model. Why? You may remember, in Finance 100, actually, to derive CAPM, we had to start with, excess returns, correlation between, excess return on individual asset and excess return on the market. So it's basically a regression model, excess return over excess return. Okay, so we're gonna, basically look into this, excess returns model, right? Excess return, of course, we understand what it is. Beta is the sensitivity of the security's return to market factor. Is arrow terms, a Greek character epsilon, arrow terms. So firm specific or residual risk. Firm specific, factor, right? Remember, firm specific factor is non-systematic, right? So non-systematic factor, right? Non-systematic. Non-systematic or systemic, although originally they mean different things. They're not the same thing, but it's being used, interchange. I prefer to use, systemic because you don't have to spell out, right? I mean, it can, takes less time. And alpha is the stock's expected return beyond that induced by, that is induced by the market index. In other words, alpha is actually, the vertical intercept in the index model, because that's the y value when x is 0. And systematic factor will tell you y should be 0. Think about it, if x is 0, y should be 0. No matter what beta is, right? X times beta, if x is 0, y should be 0. But if it is not 0, that is, if y is not 0, right? That is, stock's expected return beyond return predicted by the market index, or induced, or predicted or forecasted. So we already understand what excess return is, and and I told you uppercase R means excess return, and so this is market excess return. This is individual stocks excess return, and this is this is called abnormal return. Abnormal. alpha is actually abnormal. Usually means it has adverse connotation, negative connotation. But in this context, it's very good. If there's an abnormal return, nothing to complain. And this is residual in return. Residual. Residual means what's not predicted by systematic. What's not predicted by systematic model and forecast the error. So we already know all understand we have a good understanding of these concepts. Next comes the security characteristic line and SCL, and you might wonder, isn't that something we have already? And there was capital allocation line, capital market line. Capital market line is basically capital allocation line for market portfolio, right? And then security market line. What is security market line? This is security market line. Security market line is basically the correlation between expected return and beta, right? X-axis, beta is on X-axis, whereas expected return is on the Y-axis, and when beta is 1, that will be expected market return. Now, and the vertical intercept is risk-free return, risk-free rate. Whereas in security characteristic line, it's excess risk against excess risk. In other words, it's the correlation between individual stocks' excess risk with the market's excess risk. Okay, and then the vertical intercept is alpha. Okay, so alpha is abnormal return. It's the alpha is the value of y value, or in this case, excess return when market excess return is 0. So if you plot, it's basically like that, and this regression line is basically it's exactly given market return. This means expected return on Dell. This D means Dell. The company Dell, right? Because the textbook took Dell for example. Given market's risk premium, right? Given market's excess return, the expected excess return on Dell is a linear function of alpha and beta of Dell times market return. And this is basically systematic systematic prediction. Also, then if we find if we express it in terms of variance, right? Then variance on individual excess return is basically variance of alpha plus beta times market excess return on the market, plus error term or residual. And then rewriting this part, we rewrite, variance. Alpha is a constant, so it doesn't have a variance, right? But beta times Rm has a variance, and residuals have variance, right? So it's going to be, it can be rewritten as this variance. Beta is the weight, so beta squared, and variance of market risk premium, and variance of residuals. And so variance beta times variance of the market risk premium is basically systematic risk, and the residual is a firm specific risk. Variance of the residual is the firm specific risk. Okay. So basically, this is the specification of the security characteristic line, and this is being repeated, but so we're out of time, so I'll have to cut the video here. And actually, this is a nice place to resume, because obviously it will take more time to go over this. A lot of time. I cannot do this in 5-10 minutes. So we'll continue when we resume. We'll start from here. Okay. Alrighty. So that's it for now. I'll see you guys in the next video. Stop.